Hi, my name is Jerry Yu, the Family Money Doctor. Thank you for watching my YouTube channel. Today we're going to be talking about the 4 ways business owner can leverage life insurance. As a business owner, you have done a great job in pouring your heart and soul to make sure your business is a success. But what you probably didn't know is that life insurance can play a pivotal role in making sure your business continues to thrive in the future. Now, whether that's a transfer of ownership issue later and down the road, or simply retaining or rewarding a top talent at your firm, we will dive into these 4 strategies today and look through the lens at both the business and as a business and as an employee, and how each one of these will work for you. See, the first one is what we call a buy-sell agreement. In other words, a business continuation plan. See, it's a legally binding contract between the owners of the firm, typically more than one, of course. By doing this, inside that agreement, it's what we call a triggering event. See, most of the time when death, illness, or termination or retirement takes place between an owner, we're going to use the proceeds from the death benefit that the other owners can use to buy out the former owner's interest from his or her estate. By doing that, we're able to prevent any forced liquidation and keep that ownership in-house. Not sure about you, but I wouldn't want to be partnered with my former partner's spouse. So this is definitely something to consider when you have multiple partners. See, most importantly, to keep ownership change in-house. At the same time, what this will do is create a ready market for the business at fair market value and allow these owners to step up in basis, creating additional value for them as they take over that additional equity from the former owner. And the second one is what we call a non-qualified deferred compensation plan. All this is an insurance-based retirement plan that the corporation owns on behalf of the employee to really retain and attract your top talent at the firm. Now, I put an asterisk mark here. As far as benefits for the organization, they're not going to get any immediate tax deductions. However, it's going to be delayed. See, this is a deferred comp vehicle. See, the corporation has a future obligation to pay out these benefits. At that time, they will receive that tax deduction from the firm. However, during that time frame, we will be able to allow this policy to become an asset on that company's balance sheet. See, it's a win-win in both scenarios. See, the best part about it is that this does not fall under the limitation of ERISA or the IRS approval. We don't have to spend all the money and all the paperwork to implement one of these type of strategies. From the employee standpoint, it's great for them because they know that if they stay within that business at retirement, they're going to get some benefit. And of course, it will be taxable to them, but it would just supplement what they already have been contributing towards their retirement plan, like the 401ks. And this is great for those type of selected employees to looking for additional way to generate wealth. See, the third and the easiest one is the key person insurance. All we're doing here is ensure that our top talent at the firm, if that individual passes away, we can help offset that financial loss and use the proceeds to find the replacement. There's no tax deduction aspect to this type of plan, but the employer will be paying after-tax dollar to fund one of these strategies, and not so much benefit to the employee. But in this case, they may get additional coverage during their retirement after they're done their years of working with that firm. But the last one, and I think the most important, is what we call an executive bonus. This is another easy to implement type of strategy that we are recruiting, rewarding, and retaining our top talent to the firm. See, I underline retain because we can have an attorney draft up what we call a vesting schedule, which really restrict their access to that policy. Unlike the deferred comp plan, the business for executive bonus gets an immediate tax write-off. Paying a premium to what the employee is what we call a reasonable compensation. So that is an entire tax deduction to the firm. Freedom to favor. So we can be a little bit more discriminatory, similar to deferred comp. It's typically for those top executives of the firm and only those type of people. Best of yet, no IRS approval. Implementation is very easy in comparison to other ways you can do so. See, from an employee standpoint, how does it work for them? Well, they're not paying any form of premium towards the policy. The only cost to them, hence the asterisk, okay, is the tax that they receive on the bonus. So you just have to be mindful of that. It could bump you up into the higher tax bracket. But at the same time, since they own it, it becomes portable. Whether they wait till the end of the vesting schedule or when they hit that threshold, they can take the policy and move it or use it and access that cash flow on the cash value on the tax-free basis. See, we talk about the 4 ways, the buy-sell, the deferred comp, the key person, the executive bonus. See, I can imagine it's hard to think about losing a partner of yours as an owner or a top individual on your firm. But we have to prepare for the glooming days. So I ask you to reach out to your financial advisor and see if one of these strategies is appropriate for you and your firm. Thank you again for tuning in, and we will see you at the next YouTube video. Thank you.